welcome to the Brain Pick a Pro Show, live from Lake Wiley, South Carolina. Really excited today. I've got some good friends, TJ and Rick on. These guys are note investors. Now, they've been big-time wholesalers, wholesaling hundreds and hundreds of houses, but they've moved into a niche, and you guys have asked, and now you're going to receive. I brought these guys on. They're going to share a lot about the note business, what they do, and how they do it. Welcome to the show, guys. How you been?
Great, Larry, man. Good to see you again.
Good to see you, Larry. Thanks, man, for having us on. We're looking forward to it.
Awesome. So start out and tell us a little bit about yourselves. One of you say something about yourself. Tell us a little bit about yourself and turn the camera towards you a little bit.
Sure. My name is Rick Allen. I'm from Orlando, Florida. Originally from Columbus, but I've lived here for 30 plus years, so I'd say I'm a natural Floridian. I've been in the real estate investment game for about 15 years. I got my real estate license. I'm a broker now. I sort of cut my teeth and started out on in wholesaling. I think that's an entry point that a lot of people do. Start with it. I met TJ working for a nationwide wholesale firm. We sourced properties. We also had in-house hard money. So I sort of dipped my toe in the water of the financial side, or the finance side. We did that for, 3 or 4 years, and then wound up opening up our own shop, and we did about 400 wholesale deals in 3 years.
Wow, great.
We were moving, man. We had a bunch of employees. We had 2 offices across Central Florida, and we were really just. It was a time when the market was right, and we were just pumping deals out. We're really fortunate to have been part of that. And then I guess it was in. End of 11, beginning of 12, we kind of sold off our share of the company and went and just started doing the fix and flip thing. And we kind of stepped in a big steaming pile of mortgage notes. It was a big, it was on accident. Had a bank agent ask us if we were interested in buying loans. And we said, yeah, we'll take a look at, what you have. And so he said, well, the debt on it's $90,000. How much do you want to offer the bank for it? I was like, well, tell them we'll give them $8,000. And he was like, no, they're not going to take that. They're not going to take that. And they countered us at $8,400. So,
I love it.
Yeah. So, fast forward through a couple hundred assets. Here we are today. We've got about $6 million under management, and we're in the process of doing a Regulation A+ Tier 2 offering, which says basically we can market to anybody and raise capital and really go out and buy a lot more of these notes. So, we have a technology platform that allows people to buy and sell notes right there online. So it's an exciting time. I'm happy to be doing this. Happy to have TJ as my partner, and let's let him.
Yeah, TJ, tell us about yourself.
Man, what's happening, folks? TJ Osterman, originally Chicago, born and raised there. Go Cubs! I'm still in my honeymoon phase of Cubs winning the World Series. I don't even remember last year's baseball season. I'm just looking forward to this year and 2 years ago. Anyways, I originally moved to Florida to be a teaching professional in golf, and came down here, and got an opportunity to buy my first investment home, and really did a good job with it, and made a bunch of money, and said, I can play golf for fun and get this real estate thing full time. So I went wholeheartedly into the real estate game, and that's when I met Rick. We started doing some wholesaling of real estate, where we were connecting investors with financing, hard money, loans for them, and obviously finding the investments also for them, and it's really, really an exciting process where I got to swing a lot of hammers, do some rehabs myself, and I really enjoyed that whole process. So like Rick said, we did, we stemmed off from the company and opened up 2 offices, one in Orlando and Tampa, had about 20 salespeople doing it, and did 400 homes around. And we're just really tired of the old managing salespeople. And so we decided, let's go off and kind of do our own thing. And so we sold our portion off of that wholesale company to one of our other partners. And from there, we ended up doing our own thing. And that's when we kind of got the opportunity, like Rick said, I won't beat it down too much, but had an opportunity to buy a mortgage note. We were looking for inventory at the time. At that time, it was very, very tough to get good inventory in Orlando area, and our prices were going crazy. Where people were just like Blackstone and stuff was coming in these big funds and just paying retail for homes.
Paying par, over par.
Yeah, and paying retail for deals. There was no delta, no place for somebody to really get in the middle there and broker a deal. So we decided, you know what, we need to find a new way. And we stumbled into a mortgage note and originally went into it saying that this was a great opportunity to get inventory for our real estate. And from there, it organically grew into, this is what we do full time now. We've been doing it 6 years. We're in the trenches every day doing mortgage notes. It was a great play for us to go into that in that direction because it wasn't relearning a whole bunch of new disciplines. Right. So for real estate investors out there looking to get into this, we're not talking about just completely stopping your real estate game. This is a nice value add to your real estate portfolio. And it's not all that difficult. It's very elusive. There's not as much education out there. So people like ourselves, it's taken about 6 years to actually get to the point where we're at now. But I think with technology leveling the playing field for everybody, we're able to now take advantage of certain asset classes like alternative assets and invest in them efficiently. Like in the past, you'd have to have a whole shop of people, loan analysts, loan servicers, the whole deal in-house to be able to do this. But we're very excited about this asset class and where it's going to go. So I guess that's what we're going to kind of talk about. So
yeah, we're also want to mention kind of that we're both fathers and husbands. So we have, I have 3 kids, TJ has 2, and we're blessed to have our families and our wives who pretty much stood behind us the whole way and have been, right there for us. So I wouldn't want to go any further without letting everyone know.
Or did I forget my wife?
I forgot mine. No, we didn't. We just wanted to get their own segment. They get their own segment.
They get their own segment. Yeah. I totally. Every time you do one of these things, you start talking, and then you're like, I just lost in thought, and then I start going into the business. I'm like, yeah, but I'm a family man too.
Yeah.
And that's important. Obviously, that's what keeps us. Unless that was it, I'd just be living in the studio apartment playing golf if I didn't have a wife and kids. That's doing a few deals here and there, but it's a big motivating factor for sure.
That's cool. And you've got a newborn, right, TJ?
Yeah, 4 months old, man. It's been thank God she sleeps through the night. I'm very blessed with her. But it was resetting. I have a 4-year-old and a newborn, and
as far as you know, she sleeps through the night.
Right. We don't know what's going on. We just I'm sleeping through the night.
Right. That's what I mean.
Hopefully, my wife is. I don't know, but I think we're good there, and. So it's been a lot going on, man. We're scaling our efforts right now, too. So balancing all that. This guy's got 3 kids, so I can't ever complain too bad because he's outnumbered. I can still play zone.
Yeah.
He has to play.
No, you're on man.
I'm on man defense. He's got zone.
I say when you have 1 kid, you're in zone. When you go to 2 kids, it's man. And when you have 3 kids, it's back to zone, but somebody's always outnumbered. I have an 8-year-old, a 5-year-old, and a 3-year-old. So it's just crazy.
You don't want them to outnumber you.
No. I would say 2 is good. If you can 2, that's all you need.
There you go. So let me ask you guys a few questions. I got a lot of questions I want to ask you, but let's start off with, the inventory as far as real estate goes. I mean, you got to market hard to get real estate deals, and I think you even mentioned that you kind of fell into this or kind of looked into this a little bit more after your first deal to get inventory for your real estate. So tell us how the inventory is real estate compared to notes available.
Well, I can tell you right now, we deal in small balance distressed loans, and that's talking about assets, homes that are not worth more than $150,000 and below.
Right.
Market the niche that we invest in, and when we're talking right now, the distressed loan market, experts are saying there's about 6 to 8 million untouched non-performing mortgage loans in the market today. And there's a plethora of reasons why they're untouched. Majority of the big banks don't have an appetite for this type of investment.
Right.
They don't have a process set up in place. They're not in the business of the type of discipline it takes to reach out to these borrowers and actually work out something on a distressed loan. They're outsourcing this to somebody that doesn't have any sort of vested interest in it. So the market for the small balance mortgage notes, non-performing stuff, is great. And that is where we're at now, 6 to 8 million non-performing loans sitting out there untouched. that are being traded through this waterfall, and they're just escalating down from huge guys to the smaller mom and pop investors. And that's all attached to homes. So if you're in the business to actually look at, and get good inventory for fixer-uppers, a lot of the stuff we're seeing is vacant. This is stuff that has been traded between big banks back and forth. It's kind of like, look, I'm going to trade you all these good loans, but you're going to have to take some of these too.
Right.
And so they trade them, and they don't do anything with these small balance stuff. And so a lot of the times these borrowers get frustrated, and what happens is they will actually just vacate the house. Nobody's contacting them. They don't know who their mortgage company is. Nobody's working on this house with them. So they're either living for free, or they're living in fear that they're going to lose their home, or they just move on. Right. And so a lot of the assets we're seeing are vacant. And so they've been sitting there vacant sometimes for 5, 6, 7 years. So you're getting into stuff to where, and the systemic effects that is happening is to the communities, it's horrible. The type of crime that goes on because of a vacant home sitting in a community is major. The statistics, I don't want to go into how deep that goes, but it's not good. Let's just put it that way.
Right.
And so, we can come in, and you can come in as an investor and kind of save the day and do what you're already doing. But also, those homes that are sitting there vacant their taxes aren't being paid and what have you. So there's a lot of inventory out there. And we're not talking about also if nobody ever just, has a hardship and, defaults on their loan again. So we're talking about an existing inventory of 6 to 8 million, low balance stuff, with stuff that's probably still being cleaned up from 2008, 10, 9, 12.
Yeah, I've definitely seen stuff from 8, 9, 10, 12 still.
Yeah, so there's a lot of inventory out there, and it's only as our next market downturn is when banks and bigger asset companies and bigger asset management companies will start selling off their distressed product again. So we're not even done cleaning up the stuff yet, and I speculate as another downturn. I don't know when, obviously, but
right.
It's cyclical, right? Everything, there's going to be a downturn. And if you're in a position right now to be in a good receiving sense of that, when this next downturn happens, I'm willing to buy all that distressed stuff. You can go to a community bank. Like, you're not going to go to Bank of America and say, let me talk to your asset manager. They're not going to talk to you. But a local community bank is holding paper that they don't want sometimes that is non-performing. And you can say, look, I'll help you recapitalize. That's one of our pitches is, look, we're going to help you recapitalize, get you that money back, because they make money lending the money, not working out borrower issues. It's a whole other issue.
Right.
So you can go in as an investor and say, look, man, I'm going to help you recapitalize. I'll take a look at any of your non-performing notes that are out there. And right now there might not be that much, but to put yourself in the position that, hey, I'm a guy you can maybe look to unload some of that stuff and develop a relationship in your community with community bankers. I don't know where your listening base is, Larry, but everybody knows a community bank or knows some people there, and that's a really good place to source some of this stuff. You're helping everybody out. So
that's really good. That's really good. So align yourself with a small community bank so that whenever the time comes, you'll be able to go in and save the day, basically, right?
Yeah. That's just the one strategy, and then obviously there's a lot of different sources. But inventory, we're not seeing an issue right now. We have a investment platform called Paperstac, PAPERSTAC.com, which we're trying to make this asset class a little bit more approachable. We're making it where technology, it doesn't seem so confusing, because when investors, and I'm sure you have some that are listening right now, say, I've gotten a tape of assets. Well, a tape is basically a spreadsheet with hundreds of rows and columns, and you're looking at it going, what am I looking at? Exactly. It's like hieroglyphics.
Exactly.
We're trying to make it easier. So that investor, that Main Street investor, that real estate investor doesn't seem so afraid, because if you can see the asset, you can see what you're bidding on, you can see what the balance of the loan is, in more of a user-friendly type of atmosphere. Yeah. And more of a system, more of a process on top of that, which what Paperstac does. We think we're going to be able to, get more people off the sidelines and into this asset class.
Yeah, inevitably what happens is somebody in the real estate game that starts looking to diversify, they're looking for inventory. They stumble into mortgage notes, and they get this type of asset. And the first thing they do is say they live in Orlando. They go searching through, and they say, aha, there's one in Orlando. And it's what we did. And we went into our backyard. And you start with the ones that you can touch and feel, and you can see it and drive by it every day on your way home and say, oh, there it is, still there. And eventually what happens after you get comfortable doing this, then you start branching out. We started out just buying in Orlando, and then we started slowly spiraling out as, eventually your capital out. There's not always going to be 1,000 distressed notes in your backyard.
Right.
There may be 10, but you may have more money than that. So then you got to start spiraling out. And we got to a point now where we're nationwide buying assets. It's kind of that's an interesting thing when you finally buy something you've actually never laid eyes on. It gets a little frightening, but it's good. You need to do that.
Yeah, and one thing I want to talk. Everybody knows what's going on with lack of affordable housing. If you're reading any sort of news and headlines, it's just showing that there is a major need for affordable housing, and because of, let's just say, this the tax break that was given. 35 to 21%, which is great for corporations. We're a corporation. We love that.
Love it. Yeah.
However, what that's doing now is it's taking away from the low-income housing tax credits that used to be utilized to build low-income housing, because now companies don't have to shelter so much, tax profits, because they would generally buy these tax credits to be able to, offset some of those tax burdens. Well, now that they just dropped 35 to 21, that's great. But if you look at the systemic effects, there's going to be a huge gap in spending for these lower income areas. And to tell you the truth, the lack of affordable housing, Rick and I and everybody in the mortgage note space, to me, I think we just discovered where a lot of them are. A lot of this affordable housing is locked up in what I call the debt purgatory. It's nobody's dealing with these. They're not REO because nobody wants to foreclose anymore. These banks don't want to do it. They're not even, they're just not inventory that's just sitting there in a purgatory. So we're able to unlock it with this mortgage note play, and you're able to provide a lot of affordable housing, especially with the rental market today. A lot of the houses that we take back because we have to, they're vacant or the borrower just can't afford it. We turn it right into a rental, an affordable rental that somebody can do, whether it be Section 8. I mean, Chicago, we bought some assets out there. Their Section 8 rental is crazy. It's $1,500 a month in a 3-bedroom, 1-bath. How can you not say that's a great investment? And there are a lot. I mean, we get tapes of thousands and thousands of homes, 150,000 and below.
Wow.
Some are not. I mean, that's what I'm saying. So if you're an investor out there and you want to find some inventory, get to know the mortgage note space a little bit. There's a lot
That's
of
awesome.
inventory. Yeah.
So I want to back up a little bit. You mentioned earlier about it's kind of a waterfall from the institutions all the way down to the small investor. Can you kind of give our listeners an idea of kind of how that works? Because, most people listening to this, although we have people listening from, all different experience level and around the country, even around the world, but, they're not going to go out and spend $50 million on a huge, portfolio.
Right. Yeah.
So tell us how that works all the way down to the small investor.
Sure. If you want to go buy from Bank of America, you need to be able to stroke a check for $50 million. You gotta pay to play. I remember we were at one of the conferences and we were up on a panel doing a discussion, and I got off, and the lady from the back office of Chase came up and handed me her card and said, "From Chase, we have a bunch of assets. We'd love for you to come take a look at them." I go, "What's your minimum buy?" She's like, $100 million. I'm like, "We're not there yet," So what happens is somebody like Chase or Bank of America will pool up their assets, and usually they'll sell them off in large chunks or tranches at about $250 million, $200 million, somewhere in there.
And who buys those? Who buys them?
Well, the large hedge funds like Blackstone's going to come in, and they're going to buy those. And they're going to look at, and they're going to take the cream of the crop assets off the top. They're going to take the stuff that they think is worth $250,000 or more.
The
that's
higher
got
priced assets.
Yeah, the higher priced assets, it's going to have a larger return for them. They don't have the appetite for the smaller stuff because it takes more manpower.
Right.
It takes the same manpower to do a smaller asset as a large asset. And they run off of a velocity model. So they'll pool those up. They'll break up, say, the remaining $50 million into, or $150 million into 3 $50 million pools. Or, a bunch of different smaller pools, maybe $5-10 million pools that they'll sell off to then a medium-sized hedge fund who will then break it up and they'll work their assets or they'll sell them off into one-off investors like ourselves. And we'll go in and we've bought assets on a one-off basis all the way through, we've bought 30 to 40 assets at a time. So it just really depends on your bankroll at that point. But you can go, and then there's trading platforms. If you're looking for a way to get assets, like TJ said, we've got Paperstac, which is a technology platform which allows somebody to go on there and really look at an asset on a one-off basis, see a picture of the asset, go through and look at the collateral file, run your investment numbers on it based off of just an online digital platform that you don't have to necessarily be looking at the hieroglyphics of a tape.
Now, are these assets that you guys have already done the workout, or you've acquired them? Oh, okay, so both.
And they're not just our assets. There's other people are. It's an open source platform, so everybody can go on there and list and buy assets. So we our end product that we do put out is a reperforming loan because we're in the business of saving houses. Our sort of goal is to save 10,000 houses or 10,000 families' homes. Awesome. That's what we want to do. So that's our end product. Is we put out a reperforming loan, where we've taken an asset that was in a distressed situation, we've stabilized the family, we've got them back on the right path and are able to let them keep their house, and that's what we put out. We also put out non-performing loans. If we get an asset, then we like to take the role of, look, we'll aggregate all the inventory into one spot and let other one-off investors come in there who can jump in and say, look, I want to save a house. That can't just be our fund. We want to let other people do it. So we'll put them on there immediately once we get them. And then as we add value to them, obviously the price will go up. A reperforming loan is going to sell more than a non-performing loan.
Right. Yes.
Well, I can tell you right now, there's the $14 trillion question is self-directed IRAs, and where all that money's sitting in there from all these, they call them the stock market refugees. And our people are very yield hungry, and they're with technology nowadays. A lot of these self-directed investors are taking their 401k and IRAs and turning them into self-directed 401k and IRAs. And a lot of the assets that they're able to buy now are alternative assets like real estate, mortgage notes. They're yield hungry. And so a lot of the times people don't want to have to deal with the rental home, with the broken toilets, the ACs. They like the cash flow. A mortgage note, a reperforming mortgage note, the product that we put out, is a fantastic cash flowing opportunity where you can basically purchase a partial of it, meaning there's 360 payments on that thing. You can buy 180 payments of that, whatever you want to do with that self-directed money. And so the retirement accounts are gigantic right now. If you're just looking at opportunity, $14 trillion sitting in self-directed IRA accounts with these guys wondering, what can I invest in? Well, if you're in the market of taking a non-performing loan, underwriting it with some, how would I say, the apple pie type of underwriting that you can do as a small investor. You see, you bake the pie that makes sense. You put something in, you put this borrower in a situation to where they're going to want to pay. You give them back that equity. If they're upside down 50%, I don't care how good of a payment you give them, and you recapitalize it all on the back end of the loan and put it out 40 years, which institutions, that's their model, a lot of them. That borrower is going to say, why am I paying on this thing? My American dream is gone. My American dream is equity. I want to have something.
They can't see the light at the end of the tunnel.
No. So we're like, don't be so greedy. We'll principal reduce that person down to equity position. Because of the discount that you can buy, you can transfer that discount to this borrower, still turn a double-digit yield, and bake a pie to where now that borrower would be stupid for them to stop paying. So it's a common sense thing that I think only a smaller investor that has vested interest in a small portfolio of loans is able to do, because they are not restricted by, my boss is telling me I got to move out 1,000 loans next month, and we just got to get them off of our book.
Also that smaller investor, they've got skin in the game.
Sure.
They're not a $15 an hour employee trying to do a workout. That's their retirement funds. Right. So they're very, very motivated to say, look, let's get that money going back into the 401k. Let's start earning that interest. And when you realize that you don't have to beat some of these borrowers over the head, and that you can sit there and work with them and talk with them and get their story and communicate and, take the label off of them of a non-performing borrower and, talk to John and see what's going on in his life, then results happen. Then you start modifying people's loans and you start getting people, back on the right path.
Yeah, I mean, we have 120 assets. We're able to manage 120 assets with a very, very small team. So, and that is in our business, 120 mortgages is very, very small. We're talking guys that are trading hundreds of thousands of loans every month. So even at 100 loans, we're able to organically reach out to these people and put that real world approach on it. And look, we're just keep paying somehow. And if you can keep these people paying, it works out. And it's unbelievable what some of the stuff you see that, like the workouts that these. And I'm like, oh, I wonder why they stopped paying. I mean, I wouldn't continue to pay on a lot of these things. They'll pay for 3 months. Yeah.
So how do you guys pick your assets?
Well, we look at, like I said, a big criteria is small balance stuff, homes that are worth $150,000 and below.
The low price band.
Yeah, low price band stuff. Any part of the country. We like non-judicial states. There's judicial and there's non-judicial. The reason why that's
explain that to our listeners.
Is that foreclosure. Non-judicial, you can have a foreclosure that can take place. You still have to foreclose, but it's a lot faster.
It's a sheriff's sale.
Sheriff's sale. And then the judicial process can take you, people can run that out a year and a half, and so you're not getting that money back. But yeah, anything that's low value stuff we look at. We call them the island of the misfit toy notes. Nobody wants them, but there's huge upside.
Right.
If you can just learn a few disciplines on how to work these out. There's a lot of juice left in those oranges.
Yeah, we also we're focusing on stuff that's owner occupied because our mission is to save the house. We're not really trying to buy the vacant house. That's not our cup of tea to get the house back. It's really to save the home. So we're looking for owner occupied stuff, and then we lay a filter of there's a hardest hit fund. I don't know if you're familiar with that.
Yes. Explain it to our listeners, though.
So the hardest hit fund, the Fed set aside $9 billion that they gave to the states that got hit the hardest in the downturn. And they gave this money to them with the intentions of, look, distribute it out to the people who had a hardship to try to catch them up on their loans or pay down their principal balance so they have some equity if they're upside down. And so if you have a borrower that's got a hardship or they're upside down, you can have them apply to the state, and it's money that the state will essentially pay to whoever the lien holder is to catch them back up and get them back on their feet. So we use that as a sort of a secondary filter over non-judicial because, that if that happens, on top of it does great things for your yield and it really helps the bottom line. It also allows you to really help these people out because in some cases, we've been recapped all the money we put out. We bought one $75,000 in debt for $13,000 and wound up getting $18,000 to catch them up on their payments from the hardest hit fund. So we were already we still had the $70,000 in debt. So we were able to work with the lady and say, well, your house isn't worth $70,000, so we can modify the loan. And you can do stuff like that, and it makes it a lot easier to really give people amazing deals. It's going to set them up for their life. Really.
And you got nothing in the deal at this point.
Oh, no, we're making money. Everything on that's just gravy. So the hardest hit fund or any of these government programs are really, really good stuff that we like to look at. And then, for your investors, I would say if you start working in an area, it's all about your boots on the ground. When you have boots on the ground and you can develop your team, you can really start plugging away at that area. And when stuff comes up there, you're not having to reinvent the wheel every time you open up a new city. And so, we've got a lot of a great team going in Chicago right now is one that's just on the top of my head because we have something going there to where that makes all the difference in the world of if you have to take the asset back.
Right.
So.
Right. That's good. So what does your team look like?
Well, we have Rick and I are full-time running our fund, and that's sourcing deals, running the due diligence, drilling down into each individual.
Sourcing capital.
In sourcing the money. We have Miriam Burgos, who is our she's kind of works director of operations. She does just about everything. She helps filter out a lot of the noise for us, and we couldn't be here without Miriam. She's unbelievable.
Work wife.
She comes from a background of working with 7-Eleven on the corporate side with real estate, doing a lot of investor loans. So she's familiar enough and can really help us run our 120 assets right now very efficiently. We have a marketing guy, Brett Berkey, who is fantastic. He does just about everything now too, because we're all kind of hustling right now, trying to wear as many hats as we can. And we have a really good developer that helps with the technology side of stuff, to where we can help promote this asset class to more investors through technology, because obviously to us that's the future. And when you're talking financial technology, they call it fintech. It's lacking. Like it's really behind. So if you can bring a product that is that has some technology to it, it really the market is very receptive to it. It's hard to crack, but so that's what our team looks like now.
Yeah, we also have a litany of third-party outsource servicers that we lean on heavily to help leverage. Miriam's work time, our work time, that do a fantastic job. SN is our servicer, and I couldn't get on a pedestal and shout enough praises about them. Along with some other technology pieces.
So you use a third-party servicer?
Oh yeah.
Yeah.
I'm sorry, I even forgot.
Yeah.
We use in order to bootstrap. Like what we do is you have to be able to leverage your time, and we don't have $10 million operating budget, and there's a lot of moving parts here. So the great thing about it is there's these servicers that are more boutique style servicers that are specialty servicers. They do charge, but because you're working in a very heavily regulated environment, you can self-service. I do not recommend it. If you have a good attorney, go ahead and do that, and it depends on what type of stuff you're doing. And you can be successful that way. We didn't decide to do that. We use a third-party servicer. They kind of quarterback all the debt service. They kind of quarterback a lot of the coordination when it comes to dealing with REO agents that we can reach out to. So we're able to leverage them a lot, and there's a lot of them out there once you get into this space. So, we use SN servicing, which is fantastic. There's FCI, which are really, really good. There's Madison Management, which is another great, and they're all different. And we have loans with, a few of them. And it all depends on who you like to work with, and how creative you want to be with your loss mit strategy. We wanted to kind of do our own loss mit. We utilize a non-for-profit also to reach out to our borrowers to lower that resistance. Remember, these borrowers have been kicked around. If you go into them with the traditional sense, they're going to put up their walls again and probably go dark. You want to just get them talking and what's going on? Let's get this loan paying again, or let's come to a resolve here. And the non-for-profit housing counselors is our first reach out. And they go out and they just say, hey guys, look, we're a non-for-profit. We're here to help you. We represent, Rick and TJ and Cloud Capital Management, and we're willing to, these guys are willing to work with you. And we have a strategy where we do 70% of what you were paying when you defaulted of your principal and interest. Let's get you started on that for 6 months. Let's just get you going. And then during that 6 months, it gives us some discovery time. Let's find out what kind of person you are. If you default on that 70% of principal and interest, maybe it's a reality check that we should turn the page and maybe help you move out. We can give you cash for your deed. We don't have to worry about foreclosing on you. We'll give you cash for your deed and help you find a rental home. I mean, we've given up to $20,000 for somebody to move out of their home. Wow. Just because the discount that we've had into the deal, it was so much more valuable to get that deed and move forward at that point. And they realized that too, that that's the beauty of it. So as far as a team, immediate team, we kind of went over that FCI and SN servicing team, and non-for-profit housing counselors. Everybody probably knows one of them. Those are some really good staples to get working with you guys.
They're good tools to put in your tool belt. Is what they are.
Yeah. Exactly. So so you guys use third-party servicers, and you use a nonprofit to help you with the workout. And I'm assuming you also use a third-party workout company or loss mitigation company as well, that's going to either get it performing or get them to sign a deed in lieu or whatever.
Well, that's kind of what the non-for-profit does for us. We've given them the script on what we're looking to do, and the non-for-profit allows us to reach out to somebody very early in the process and say within compliance. And their job when they get in there is to say, hey, first question, do you want to keep your house? If you want to keep it, we're here to help.
Right.
If not, then we can start going down the road of deed in lieu of foreclosure or consent judgment, stuff like that. And then obviously we'll jump in or have our third party servicer jump in to draft up anything that needs to be drafted.
Right. That's awesome. That's awesome. Guys, this is really good stuff. I'm assuming your developer on your team, that's the one that helped you with the Paperstac website.
Yeah. Yes, it is. We started Paperstac, I think 3 years ago. And, we were outsourcing to one of the online platforms for a developer, and it just didn't work out. We didn't get the best quality work. And so we brought in, his name's Mike McClin. We brought him in as a developer, gave him a piece of the company. And he's, not only is he great at the back end development, he knows front end development, and he's got a great business acumen as well. He's got a good mind for the business side of life too. So it's been a huge asset to add to our team. Yeah,
the whole story of the development, we first realized like 6 years ago, we did a trade and we both looked at each other and said, holy cow, what did we just do? We wired like $250,000 to somebody that really, said they were a good seller. And we were like, why is this so hard with the amount of technology today out there? Why is this so hard? So we looked at that and said, let's develop something that's a little bit easier to look at than these tapes. And so it's like, it's really not all that difficult. So we went and did it overseas with some developers, spent like 20 grand and got back a crappy product and realized, wow, you have to spend the money in this development world. These developers make really good money because they have a very esoteric type of talent that not a lot of people know or how to do. So it was funny that we started developing it 6 years ago, and only up until now, we're actually at a product that's, because once you start unpacking it, you realize, holy cow, there's a lot involved, a lot of moving parts, and to be able to do it right.
Just the coding side of life, just to understand, like when you go to develop a platform, man, the logic that actually goes into it is you could be stuck on one piece on just a process and how the logic has to work. It's been a whirlwind of knowledge. It's a fire hydrant of information, really.
That's amazing.
Yeah.
Well, guys, listen, you have provided just a wealth of information to really help our students learn about the note business. If some of our students wanted to reach out to you, how would they get in touch with you?
You can get me at rick@paperstac.com. It's PAPERSTAC.com.
You can do TJ at paperstac.com. PAPERSTAC.com.
Yeah. Okay.
No, and you can go to www.cloudcapitalmanagement.com. That's the main company. That is our company that we're currently, we run. That's our investment company, and all the other projects kind of fall underneath that. And you can kind of read a little bit of our investment thesis there. And if you want to reach out that way too, we'd love to help anybody out there, answer any questions. We're really excited to see what the future holds.
That's awesome. That's awesome. Well, guys, thank you so much for being on. I really, really appreciate it. And guys, if you guys out there listening, watching, have any questions, please don't hesitate to reach out to TJ or Rick. They'll be glad to answer any questions and help you guys, I'm sure. Right, guys?
Absolutely, Larry. Thank you so much. Good seeing you.
Awesome. Good seeing you. Thanks a lot, guys. I appreciate it.
Yep.
Thanks.
All right. Thanks.